let's talk about how the Fed played a role in the Great Depression. The group members are Sam Dalton, Charlie Watkins, and Arya McCarthy. The Federal Reserve's policies during the Great Depression were ineffective due to periods of inaction and underestimation of economic problems. Furthermore, its decisions in the late 1920s can be cited as an impetus for the Depression's onset.
A popular economist of the 1920s, Irving Fisher, believed that price level stability should be the priority of the Fed, and the governor of the New York Federal Reserve Bank believed him. Once the governor of the New York Fed died, the Fed switched the direction of their policy and pursued a new course, which necessitated backed currency and securities, cutting the money supply by 30% as a result in 1928. When the stock market crashed in 1929, the Fed, instead of purchasing government securities to bolster bank reserves, employed tight money policy that pushed the economy even further into the recession. The Federal Reserve bought few securities and dropped the interest rate from 6% to 4%, but this was not enough to counter the supply decline. The continuing drop in money supply caused bank runs, and instead of aiding the banks, the Fed let many of them fail entirely.
Now let's look at some graphs because all the real economists do models. First, let's look at what the Fed had direct control over, the money supply. Prior to the Great Depression, the Fed cut back money supply, raising interest rates in hopes of curbing speculation in the stock market. This, with the combination of their real bills doctrine, implemented in 1928, cut back the money supply by almost 30%. As a result, money supply obviously moves to the left and interest rate increases. And due to increased interest rates, investment decreases. Now let's talk about how that affected aggregate demand and in turn real GDP. Remember, investment is a component of aggregate demand. Because investment decreases, we can say aggregate demand will as well. Also, due to less wealth because of things like the stock market crash, we can expect less consumption. With these two components of aggregate demand decreasing, we can also expect aggregate demand to decrease, lowering production and real GDP.
In summary, the Fed's inaction, and sometimes harmful action, during the late 1920s can be held as one of the reasons that led to the Great Depression. When the Fed did react to the Depression, it was not on a scale large enough to prevent further recession. This only proved the Fed was inexperienced in handling the economic turmoil of the nation. However, the Fed was taught many lessons that helped improve its monetary policy for future economic downturns.